Hi, this is Dana Stalder with Matrix Partners. I'm here with Hans Morris with Nyca Partners, part of our ongoing series on fintech. And today we're talking about innovation in some of the larger banks in the United States and where there's opportunities for new companies to be built and how entrepreneurs may work with or sell into some of these large banks.
Great.
Look, we're amidst a giant trend of innovation in financial services and fintech like I don't think have ever seen in history. And the more interesting part is the banks are not playing a significant part in that, in spite of the power of them as incumbent. So why is it that we don't see more innovation from the largest banks in the world?
Right. So I think that there's several different issues. So let's pick apart. So one is banks went through, as a result of the financial crisis, a very, very significant re-regulation cycle. So if we go through history, deregulation, regulation, Dodd-Frank Act dramatically increased regulatory requirements for banks in terms of the amount of capital they need, in terms of the business requirements of almost every line of business they're in changed dramatically. So increased all new innovation has very high hurdles to pass for a bank. Second thing is they really, as a result of the financial crisis, was they were necessarily reducing lots of expenses. Tech spend was a big area to cut, and so they removed a lot of the innovation engines that they had. So they're rebuilding them now in many cases, and I think Capital One and BBVA and Citi, JP Morgan, Bank of America have all been trying to gear up more. And there's some really great banks like PNC, I think, has done some very innovative things in a very focused way. But generally, they cut a lot of that out. The other thing is not specific to banks, which is that I'd say almost all large companies have a development cycle that makes it essentially impossible to build software when things are changing rapidly. So the typical development cycle at Citigroup, for example, would be 2 years of planning and an initial build. And then by and if things are all changing rapidly, like if you were saying, going back to things we're talking about with consumer payments or NFC, not NFC, well that's pivoted a bunch of times over the last 10 years. And then to roll it out, to actually have something that's going to be rolled out in all your different to all parts of the organization, maybe literally like a 5 to 10 year cycle. So Citigroup, which is global, I would say start to finish, roll out to 100 countries, 10 years.
Now, what's interesting is a lot of companies will drive innovation through acquisition, but it seems to me, on a relative basis, the banks have been particularly acquisitive of new models as well, right? So you're on the board of directors of LendingClub. I mean, that's an interesting example where amazing innovation in the consumer lending space. It's surprising to me that some of the largest banks, who are the largest consumer lending companies in the United States, didn't buy LendingClub or one of their competitors years ago before this became a multi-billion-dollar behemoth. What do you think's kept them out of acquiring innovation like you'd see a lot of big, large-cap tech companies do?
So two things on that. One is a fact about the bank capital rules, which is that if you think about almost any tech company, almost 100% of the purchase price is goodwill. So the tangible assets that they
intellectual
have
property
would be very small, and so intellectual property and even customer contracts. So there's a little bit of a difference between goodwill and identifiable intangibles from an accounting standpoint, but from a bank capital standpoint, for purposes of this analysis, like a tech company, it all is the same. So 100% deduction from your tangible equity. So that suddenly, if you say, oh, what's the return on equity of this investment? Usually it is terrible with that standard.
Right.
So that makes it pretty hard. If the thing gets to be any meaningful size, if you start saying it's 100 million or higher, and you have 100 million destruction of your tangible common equity, that makes it very hard. The second thing is that all of the regulatory compliance issues. So something that is fine for a Silicon Valley startup in terms of your information security standards, your documentation, the development process you use, the rollout of new products, the way you do release management, all the things which are standard out here are not acceptable in many cases to in a bank requirements, regulatory requirements. And a big one, by the way, which I don't think many people in Silicon Valley are focusing on, is data compliance. So if I know, for example, if I use bureau scores, if I pull that from any one of the three bureaus, that information is in that scoring model. They would have looked at 10,000 different potential variables to see what actually drives better outcomes.
Right.
All the data that they select, let's say they will then select 200 different variables to put into their model, Experian or one of the others. All that data is compliant. So from a Fair Credit Reporting Act and all the other consumer lending rules that apply to it, you can be certain that if it turns out that you are then have regulators come in and look at the way that you made credit decisions, it's compliant data.
Yeah.
If I found out, let's say I'm a Silicon Valley company and I'm saying I'm using all this interesting data out here, and I found out that people who have a certain breed of dog are better credit risk than people who have a different breed of dog. That might be compliant, probably, maybe, but no one can say for certain it is. If I find out, I found out that that Germans are better credit risk than Taiwanese are, something that is definitely not compliant, right? Or even age is not compliant, and so. This issue, what's acceptable for a small little startup kind of finding interesting things, and what's acceptable for a large regulated bank, you're in the crosshairs of CFPB and a lot of other agencies. It's not worth the risk. No one's you got to make sure it is compliant before you apply it.
So do you think we're headed I heard a term just in the last month. I had dinner with the CEO of a large global bank, and he used the term, and he had been touring Silicon Valley, and the term he used was shadow banking system had emerged in a bigger way than he had imagined actually when he went out, because many of these companies all have financial sponsors behind them, right? So are we headed towards a world where the banks are increasingly become kind of the sponsor, the regulatory representative into the regulatory system, if you will, and then all the innovation is done by third parties, and then there's just a battle between trying to share profits?
To some extent, I mean, fundamentally, I say this a lot to people in Silicon Valley, is like, you can't disrupt the entire financial system. Like, whatever you're doing, you need to, if you're going to offer credit, you need licenses, or you need in many cases a balance sheet. So sometimes you need access to deposits. You definitely need to settle transactions, right? You need to get cash back and forth. You need to move money, and you need accounts to be set up. So everyone, you're connecting into the financial system in some way or another, and whether that's a bank or a broker-dealer or some sort of regulated entity, that's going to be part of your future in some way. You need to have those relationships. The banks, I tend to be, I think, sympathetic to their plight. I mean, they're not stupid at all. All those, everyone if you go through the CEOs, they're smart. They get exactly what's happening. It's just that the challenges are great, and so and they want more access to innovation, and they are, I think, seeking more ways to do this, some of which are interesting new ideas. But I do think you will have. I think there will be some interesting vendors who are actually focusing on some ways that will let banks innovate more quickly, let them get shorten up that development cycle dramatically. But it's
it seems like there's hard. It seems like there's an opportunity for some of these big banks to figure out how to open their systems and to architect themselves to play a larger role in the sponsor model and work with third parties.
Yep.
And is that a trend that you see underway or may be emerging?
I'd say if you said, I don't know the number off the top of my head, but I think there's 6,000 banks in the United States. You say, like, how many are really doing innovative stuff and really putting a lot of resources, effort into it? It's a very, very small number.
Yeah.
But some of those they offer a lot of other advantages. And there's, we pick one topic, like, security. So security is a big issue, and as a consumer, you care about that. Yeah. And a bank can create a very secure environment for you, but also has a reputation, I think, for being secure. And they have a balance sheet because they can stand behind that environment. So if it's wrong or if there's a mistake, they can protect you, and indemnify you in effect. There's a lot more I think the banks, a smart bank could do to take that level of trust, because if you think about trust, during the financial crisis, trust levels went down terribly, and the customer service complexity the banks have to deal with also makes it hard to deliver a trusted, seamless, good experience, meeting the expectations of those consumers for the kind of a tech-enabled, curated life. Yeah, they don't find it easy to deliver that. Could they do it? And could they add to that, like this security and confidence? Yeah, there's a lot they could do, but it's as I said before, so it's hard to build and hard to do it. So what I would definitely expect is more smart marriages of companies providing these services to the banks to help them get there, and
so it may in fact become easier for entrepreneurs to actually work with banks and partner with banks to create innovation.
But there is, I think that's a good opportunity. But there's another big inside baseball issue which has huge consequences that I don't think anyone in Silicon Valley is particularly focused on this. But if you are selling to banks, one of the other regulatory changes that took place is the vendor rules for banks got much, much tougher, more stringent. So it's actually the standards of becoming a startup that is going to get accepted by banks for a pilot or actual implementation are very, very high. And the questions, if you get, let's say you have this great meeting and you got this incredible product, and the banks obviously need innovation. They want that. Perfect. You meet some senior executive at the bank, you got the solution they're looking for, you have a couple of fantastic meetings, you're ready to go. Then it gets handed over to the vendor management team, and you will get a questionnaire, and this is not an exaggeration, it will be about 500 questions. And those 500 questions will address everything from your financial statements to your compliance to all your regulatory, all your licenses, who your CISO is, what your compliance manuals, and many early stage companies freak out when they see this. And also on its face, like, you need 3 years of audited financials, you will fail. Now, in all cases, you could still get this. If the senior executive wants to do it, they can do it, but they need a mitigant for each one of those risks.
Right.
So the standards are high. There's a lot. I think helping those companies prepare for this is a key thing. And I think that, again, remember I was talking about with like payments, that the things that get done that are successful are things for which there's no solution.
Yeah.
My view on enterprise with banks is, I said, basically the only things that get through that process are things that are mandatory. So for example, network security, huge issue for the banks. So there are many mandatory requirements that they have to do. Companies have innovation solutions that get you there faster. A company has a roadmap, but now you can take something that was going to take 2 years of development, and you have it right now. That can get done fast. The senior executive will say, do it.
Yeah.
And the vendor management people, instead of being, cutting you out, are now trying to figure out how to get it done. So that's what you need. That's what we focus on when we're looking at enterprise.
Good. Thank you for your thoughts.
Okay. So it's a pleasure. Thanks.